Alright guys, something very strange happened in France, and the silence is what makes it dangerous. In early December 2025, the country was bracing for chaos. Major unions called for a near-general strike. Schools were expected to close. Trains were supposed to grind to a halt. Hospitals warned of disruption. On paper, this looked like the opening act of a nationwide breakdown, but when the day arrived, the streets stayed quieter than expected. The disruption never fully materialized. To a casual observer, this might have looked like relief, like tension easing, like the crisis backing down. But that interpretation completely misses what actually changed. The crisis did not disappear. It migrated. While cameras focused on empty plazas and half-filled marches, the real action had already moved somewhere far less visible and far more dangerous. It moved into the financial system. Markets were not watching turnout numbers. They were watching yields, spreads, and capital flows. And what they saw was not calm. It was panic in slow motion. France was no longer dealing with a protest problem. It was dealing with a confidence problem. International investors who hold roughly half of French sovereign debt began reassessing risk in real time. That matters because foreign capital does not negotiate, it does not protest, it exits, and it exits fast. The quiet on the streets was not a sign of stability returning. It was a sign that pressure had already shifted away from public confrontation and into institutional trust. Once that trust starts eroding, it does not make noise, it drains. This is the core thesis of what is unfolding. France is not spiraling because of one strike or one budget or one unpopular reform. It is spiraling because the mechanisms that signal control and predictability have broken down. Markets do not require perfection. They require coherence. And when coherence disappears, they price in risk long before society visibly cracks. By the time the average citizen feels it, the damage is already baked in. This is why the calm was misleading. This was not de-escalation. This was the eye of the storm. And the storm was no longer political theater. It was financial reality reasserting itself. Now here's the part most headlines get wrong. Markets are not afraid of protests. They are afraid of paralysis. What set off alarms was not noise in the streets, but silence in decision-making. Since late 2023, France has cycled through leadership at a pace unseen in the modern republic. 5 prime ministers in roughly 2 years is not political churn. It is institutional malfunction. This matters because governments are not judged by intention, but by throughput. Can they pass a budget? Can they implement policy? Can they adjust course when conditions change? In France, the answer has increasingly been no. Parliament is fractured into 3 opposing blocs that cancel each other out. The left lacks a majority. The center cannot build coalitions. The right blocks without governing. The arithmetic does not work and the culture does not compensate. Unlike systems built for coalition bargaining, French politics is designed for decisive winners. When no winner emerges, the system freezes. This is the hidden constraint investors are reacting to. A country that cannot agree internally cannot credibly commit externally. That is why previous attempts at fiscal correction collapsed. When spending cuts were proposed, ideological rivals united only to stop them. The result was not compromise but collapse. From a market perspective, this signals something far worse than an unpopular reform. It signals the absence of an enforceable path forward. Debt does not wait for consensus. Interest does not pause for elections. Every month of gridlock adds to obligations that must be serviced regardless of who sits in office. This is why political instability translates directly into financial risk premiums. Investors are not making moral judgments. They are doing probability math. If leadership changes but constraints remain, policy volatility increases. If policy volatility increases, long-term commitments become unsafe. And when commitments become unsafe, capital demands compensation or leaves. This feedback loop is what terrifies markets. Not drama, but drift. Not anger, but inertia. France is being repriced not because it is weak in absolute terms, but because it is unable to convert strength into action. And in a world where alternatives exist, that inability is punished faster than ever before. So, let us talk about the numbers, because this is where the abstract suddenly becomes unavoidable. France is now carrying a national debt exceeding $3 trillion, roughly 114% of its annual economic output. That alone places it far above the threshold Europe once defined as sustainable. But the real problem is not the stock of debt, it is the flow. France continues to spend significantly more than it collects, with annual deficits hovering near 6% of GDP, double the official European limit. This combination creates what economists call a debt trap, but in practice it functions more like gravity. The heavier the debt becomes, the harder it is to move without expending enormous energy. Higher debt makes investors nervous. Nervous investors demand higher yields. Higher yields increase interest costs. Rising interest costs expand deficits. Expanded deficits add to debt. The cycle feeds itself. And unlike political crises, this cycle does not require headlines to continue. It runs automatically. Government projections now show interest payments alone climbing toward levels that rival or exceed core public spending categories. Money that could stabilize society is instead allocated to servicing past obligations. This is where the crisis becomes structural. Cutting spending risks social backlash. Raising taxes risks economic slowdown. Doing nothing guarantees deterioration. Each option carries cost, but indecision carries the highest cost of all. Markets see this clearly. They are not asking whether France will default tomorrow. They are asking whether France can plausibly bend the curve before the math overwhelms policy. And increasingly, the answer looks uncertain. This is why confidence is evaporating faster than rhetoric suggests. Financial systems are forward-looking. They price not what is, but what is likely. And when the trajectory points toward constrained choices and rising obligations, the response is brutal but rational. France has not hit a cliff. It has entered a slope. And slopes are dangerous because they feel manageable until momentum takes over. By the time emergency measures are discussed, the leverage is gone. This is the quiet brutality of arithmetic. It does not negotiate. It accumulates. Now we arrive at the moment when perception officially broke. Every crisis has a point where numbers stop being abstract and start rewriting reputations. For France, that moment came when its long-term borrowing costs crossed a line that had never been crossed before. The yield on French 10-year bonds rose above those of countries once defined by crisis. This was not a technical fluctuation. It was a verdict. For more than a decade, Greece symbolized European financial failure. It required bailouts, external supervision, and years of austerity. France was supposed to be the opposite, a core economy, a stabilizer, a guarantor of continuity. When markets began demanding a higher risk premium from France than from former bailout states, it signaled a complete inversion of trust. Bond yields function like a global credit score updated every second. They reflect not ideology but confidence in future repayment under political stress. When France was repriced, investors were not predicting collapse. They were acknowledging uncertainty. The political system in Paris was now viewed as less capable of managing its obligations than systems that had already endured crisis and reform. That is the psychological shift that matters. Once a country loses its status as a safe benchmark, everything else becomes harder. Borrowing costs rise not only for the state, but ripple outward into banks, companies, and households. This creates second-order effects. Credit tightens, investment hesitates, growth slows. Slower growth worsens debt dynamics, the trap deepens. This is why this data point mattered more than protests or speeches. It told the world that France was no longer being treated as an anchor but as a variable, and variables are priced defensively. Reputation in finance is cumulative but fragile. It takes decades to build and moments to crack. France did not fall because of one decision. It slipped because markets collectively decided that the margin for error had vanished. From that point on, every delay, every stalemate, every inconclusive vote compounds suspicion. Trust once lost does not return quietly. It demands proof, and proof requires action. That is the bind France now finds itself in. Here's where the crisis stops being a French story and becomes a European one. France is not a peripheral economy. It is the second largest pillar of the Eurozone. When stress appears there, it cannot be isolated. Financial systems are built on assumptions of correlation. When one core asset is repriced, investors immediately ask what else shares similar traits. High debt, political fragmentation, limited growth. This is how contagion begins. Not through panic selling, but through cautious reallocation. Borrowing costs begin to rise elsewhere, not because fundamentals suddenly changed, but because confidence did. This puts European institutions in an impossible position. The European Central Bank exists to stabilize markets, but intervention carries political cost. Large-scale bond purchases can calm yields, but they also blur the line between monetary policy and fiscal rescue. That line is already sensitive after past crises. The difference now is scale. In earlier episodes, stress concentrated in smaller economies. Today, the potential epicenter sits at the core. There is no realistic bailout framework for a country of this size without challenging the credibility of the entire system. This is the hidden risk markets are quietly pricing. If France cannot stabilize itself, the architecture of the Eurozone faces questions it was never designed to answer. Can a shared currency function when one of its anchors is politically immobilized? Can solidarity substitute for governance? These doubts feed on themselves. Even the expectation of intervention can distort incentives, encouraging delay rather than reform. Meanwhile, higher yields divert resources away from productive investment across the bloc. Growth slows collectively. Fiscal space shrinks everywhere. This is how a national paralysis becomes a continental constraint. The irony is that no single dramatic failure is required. The system weakens through accumulation. Each unresolved budget, each postponed reform, each month of drift raises the baseline level of risk. Europe is not helpless because it lacks tools. It is constrained because every tool now carries consequences that extend far beyond the problem it tries to solve. France's standoff has become Europe's stress test. Now let us zoom out, because the most consequential reactions are happening far from Paris and Brussels. From the perspective of major Asian economies, France's turmoil is not viewed emotionally, it is viewed structurally. For decades, countries across East and Southeast Asia built growth strategies around predictability, long-term planning, institutional continuity, policy execution. These traits attract patient capital. When observers in Asia look at Europe today, they see fragmentation where coordination once existed. They see rapid leadership turnover. They see difficulty passing basic fiscal legislation. To them, this is not an isolated crisis. It is confirmation of a broader trend. Capital controlled by Asian sovereign funds and institutional investors prioritizes stability over narrative. These actors manage trillions in long-horizon assets. They are less interested in short-term yield spikes and more concerned with policy reliability. When a core European economy begins to resemble a question mark rather than a benchmark, allocation decisions shift quietly. This does not mean abandonment. It means diversification away from uncertainty. Over time, that reallocation has power. Reduced inflows raise financing costs. Higher financing costs reinforce fiscal strain. Influence follows capital. This is how economic gravity moves without confrontation. The rise of Asia in this context is not about aggression or rivalry. It is about relative coherence. While Europe debates, others execute. While policy in France stalls, infrastructure, trade networks, and industrial strategies elsewhere continue advancing. The result is a slow rebalancing of trust, and trust is the ultimate currency. France's crisis accelerates this shift not because it creates opportunity elsewhere, but because it undermines confidence at home. In a world with multiple credible destinations for capital, indecision is punished not by rhetoric, but by redirection. This is the quiet consequence Paris cannot vote away. Global capital does not wait for resolution. It flows toward environments that appear governable, and once those pathways are established, reversing them takes far more than stabilization. It requires restored belief. Now we reach the geopolitical consequence that rarely makes headlines but reshapes outcomes all the same. When a major power turns inward, it does not announce retreat, it simply loses bandwidth. France today is operating in political survival mode. Leadership energy is consumed by no-confidence threats, budget deadlines, and coalition arithmetic. That leaves little capacity for sustained international initiative. Diplomacy requires continuity. Influence requires follow-through. Military posture requires predictable funding. When these weaken simultaneously, a power vacuum forms without confrontation. This vacuum does not stay empty. Other actors advance not by challenging France directly, but by filling spaces it can no longer actively occupy. Trade negotiations proceed elsewhere. Infrastructure deals are signed by others. Diplomatic mediation shifts to states with fewer internal distractions. Over time, absence becomes normalized. This is how multipolarity accelerates. Not through dramatic displacement, but through quiet substitution. France still has capabilities. It still has institutions. But credibility is comparative. When partners sense distraction, they hedge. When hedging becomes routine, alignment loosens. This is the second-order effect of domestic paralysis. It reshapes external expectations. A country fighting to pass a budget cannot reliably anchor long-term commitments abroad. That reality does not require malice from competitors. It invites opportunity. Meanwhile, public messaging at home grows louder as policy impact abroad fades. This imbalance feeds cynicism internally and skepticism externally. The more France appears trapped in procedural conflict, the less weight its strategic positions carry. This is not collapse, it is dilution, and dilution is harder to reverse because it lacks a single point of failure to fix. By the time leaders recognize the scope of influence lost, the terrain has already shifted. The world does not pause for recalibration. It reallocates attention. France's internal deadlock is quietly rewriting its role, not because others are pushing it out, but because it is no longer fully present. That is the cost of prolonged paralysis in a competitive global environment. So what happens next, and what is the real lesson here? France is effectively locked into this unstable equilibrium until at least the next electoral reset. That creates three plausible paths forward. If political actors temporarily set aside rivalry, a minimal budget could pass and markets might stabilize. But without reform, the underlying pressures remain. If paralysis continues, the more likely outcome is gradual erosion. Higher borrowing costs, slower growth, shrinking fiscal room, and declining influence. This path feels manageable month to month, which is why it is dangerous. The counterintuitive scenario is a shock-driven realignment. Rising stress could produce a decisive electoral outcome that breaks the deadlock, but at the cost of heightened volatility and uncertain policy direction. None of these paths are clean. What they share is this: time is no longer neutral. In today's system, political dysfunction carries immediate economic pricing. For decades, advanced economies could absorb instability because alternatives were limited. That era is over. Capital now compares governance in real time. It moves toward predictability and away from drift. France's crisis illustrates a broader truth. Power in the modern world is less about raw capacity and more about the ability to coordinate, decide, and execute under pressure. When that ability falters, even strong nations are repriced. This is not a moral judgment. It is a market mechanism, and it is unforgiving. France's story is not unique, but it is instructive. It shows how quickly confidence can evaporate when institutions stall and how difficult it is to rebuild once credibility cracks. The warning here extends beyond one country. Any system that assumes political chaos can be compartmentalized from economic consequence is operating on outdated assumptions. Stability is no longer assumed. It is tested continuously, and those tests are global. So the real question is not whether France can survive this period. It is whether it can restore belief before erosion becomes expectation. Let me ask you this. Do you think France can break this deadlock without a major political shock? Or has the system already crossed its point of no return? And more broadly, are we watching the early stages of a wider crisis of governability across developed economies? Let me know what you think in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.